We've had economic data out of the United States that points to a softening or at least slower growth, and that has raised bets on a Fed rate cut next month. Let's get the thoughts of Eric Teal, Chief Investment Officer at Comerica Wealth Management. Eric, thanks very much indeed for joining us. First off, does it matter if there's a rate cut next month or not?
25 basis points sounds like an insignificant cut in the scheme of things, but if you look at how this market is priced, the need for additional stimulus, earnings that far exceed expectations, these are sort of the things when you have a market priced at perfection that you're going to need to keep the momentum going. So it probably doesn't have a big effect as it relates to consumer confidence, spending by the consumer, but it does pose an important ingredient for market multiples, and we need real rates to start ticking lower. So I think additional stimulus, both fiscal and monetary, is important at this point.
Do you say that in the economy, one negative factor that's yet to fully play out is reduced immigration?
Immigration is, I think, the policy that's been least talked about and is likely to find itself weighing on markets in 2026. And I think the aspects are mixed in that you're seeing disinflation from immigration policy in rental markets come down. However, I think in some jobs, particularly, we've looked at construction, leisure, hospitality. Those are areas that have benefited from immigration coming in. As that's extracted out of the system, I think you'll get wage pressures in those particular areas and in states like Texas and perhaps Florida that have been big beneficiaries of immigration. All that balances out. We think it puts a little bit of upward pressure on inflation when you balance and net those out. But that is the key policy, I think, that has not been talked about enough, particularly as it trickles down into the inflation readings.
We talk about consumer spending numbers, retail sales, et cetera, as though all Americans were affected equally. But you say that we've got this bifurcated economy, the wealthy are doing better, and that may be giving us a rosy picture of consumer strength and spending?
No question. We've talked about this K-shaped economy. We have a significant wealth effect that's taken place from the higher stock market, asset values going higher, but that has not trickled down to the bottom 60% who felt the brunt of tariff and price increases. And not had the sort of wage acceleration to keep up with the inflation that started just a few years ago. So although inflation's moderated down at the 3%, far lower than we were a few years ago, those price increases were locked in. They're permanent. There hasn't been disinflation to offset those, and wages have not kept up. So the bottom 60% of income earners been negatively impacted by a lot of the policies, particularly tariffs. So we've got relief on the way from tax cuts coming in the second half. And I think some settling of the tariff price increases, but it's been a bipolar market. And I think as we look at spending for the consumer, those luxury items and high-end retail, that I think will continue to bode quite well in the market as we get further into next year.
You are suggesting that investors overweight small and even micro cap stocks. First off, give us your definition of a small cap. What I know it's hard to be categorical, but
Small caps typically can be below $3 billion in market cap. It's crept up. It used to be much lower than that just a few years ago. But there's a lot of things lining up right now, I think, for small cap, particularly when you think about interest rates that are being cut. Tends to be very stimulative for small caps, a steeper yield curve. Now, when you talk about micro cap, you're talking about typically companies that are under $1 billion in market cap. In this universe, there are lots of low-quality companies. I refer to them as sort of the zombie companies walking around unprofitable, not making money. But there is quite a bit of of profitable companies, at least 60% of the universe that is in good shape, I think will benefit from some adoption of AI, the steeper yield curve that I alluded to, and then continued deregulation and consolidation that takes place. So small caps are at a significant discount to large caps. They do not have nearly the concentration, not only at the stock level, but also not at the sector level in an area like technology. Much more diverse. You've got exposure to, I think, areas of the market like financials that are ripe for consolidation. They've done well of late. But I think that sort of shift is likely to take place as we get some rotation and broadening of the market as we head into next year.
You're saying underweight the Mag 7. Sorry, just to reiterate, Mag 7. You're cautious. You say valuations are not extreme. Carry on.
Valuations not extreme at this point. However, when you look at the Mag 7, with really trading at a 45% premium to the overall market multiple, the S&P in itself is expensive by historical standards. And if you look at projected returns going forward, it does not bode well for future returns. However, you have to look for opportunities where you have stock selling at discounts outside of the Mag 7. And I think those areas of the market like financials look more ripe for returns. And then you look at areas like small cap that have not participated in the rally. And that's where you can find opportunities. They're all expensive by historical standards. So I think you have to look at those forsaken sectors. And small cap would be one. More value-oriented sectors in the S&P would be another, where they're expensive, but not nearly priced to perfection that you see in technology stocks at this point.
Eric, thank you very much indeed. Have a wonderful Thanksgiving, by the way. Eric,
thank you. Likewise, you too.
Eric Teal, Chief Investment Officer at Comerica Wealth Management.